You scroll through your friend's group chat or Facebook feed on a random weekend. Someone posts photos of their new place, open concept kitchen, big backyard for the kids, nice neighborhood, good schools. Caption just closed on our $500,000 dream home, feels unreal. Another friend comments, congrats, that's the sweet spot right now. Not too crazy, but still a solid investment. You nod to yourself, $500,000. It doesn't sound insane anymore. The median home price is around $430,000 to $445,000 nationally in early 2026. So $500,000 feels reasonable, achievable. You do the quick mental math. Our household makes $140,000 to $160,000 combined. If we save aggressively for a down payment, maybe stretch to 10 to 15%, lock in a fixed rate, we could probably swing it. The payment won't be that much higher than rent, and at least we'd own something. That exact moment when $500,000 starts feeling normal and doable is the most dangerous second in personal finance right now. Because in 2026 to 2027, a $500,000 home is no longer the safe middle-class upgrade it used to be. It has quietly become one of the biggest financial traps for millions of American families. It looks affordable on Zillow. The monthly estimate seems close enough. Your friends are doing it. But behind the pretty photos and the congratulations, there is a whole layer of hidden costs that most people never see coming, until their budget starts cracking under the weight. Today we're going deep into the $500,000 home trap. Who can actually afford it comfortably in 2026 without wrecking their finances? Who is stretching into house poor territory and doesn't even realize it yet, and why, even with a solid $120,000 to $180,000 household income, so many people are quietly destroying their cash flow savings rate and long-term wealth by chasing this reasonable price point. This isn't fear-mongering. It's the updated no BS math that builds on what we already covered in Rent versus Buy, where renting plus investing often came out ahead. Now we zoom in on the exact price level where most middle-class buyers get stuck: $500,000. If you've ever looked at a $500,000 listing and thought this could be us, or if you already own one and feel the monthly squeeze getting tighter every year, stay with me. Because the numbers we're about to run could save you from years of financial stress, or at least help you see clearly before you sign anything. Let's get into the real cost of that dream home price tag in 2026. So let's break this down with the cold hard numbers. Banks and lenders use rules like the 28-36 ratio to decide if you qualify for a mortgage. The front-end ratio says your housing payment, principal, interest, taxes, insurance should be no more than 28 to 31% of your gross monthly income. The back end adds all debt, car loans, credit cards, student debt, and caps it at 36 to 43%. FHA or VA loans can push that to 50% or more if your credit is strong. But here's the trap. Qualifying on paper doesn't mean you can actually afford it in real life, especially with 2026 rates and costs. Let's run the math for a typical $500,000 home. We'll use realistic 2026 assumptions, 30-year fixed rate at 6.6 to 6.9%. That's the current range per Freddie Mac and bank rate as of early 2026, still elevated from the sub-3% days. We'll look at different down payment levels which affect PMI, private mortgage insurance, and the loan size. First, with a low 5% down payment, $25,000 common for first-time buyers using FHA loan, $475,000. Principal and interest about $3,040 to $3,120 per month. To qualify at the 28% front-end rule, you need gross household income of $130,000 to $134,000 per year. At the looser 36% back end, assuming some other debt, it drops to $101,000 to $104,000. Bump to 10% down, $50,000, loan $450,000, P&I $2,880 to $2,950 per month. Required gross at 28%, $123,500 to $127,000. At 36%, $96,000 to $99,000. Go for a stronger 20% down. $100,000 avoids PMI. Loan $400,000. P&I $2,560 to $2,625 per month. Required gross at 28%, $110,000 to $113,000. At 36%, $85,000 to $88,000. These look doable, right? A $120,000 household income gets you in the door with 10 to 20% down. But this is where the trap snaps shut, because these bank estimates only cover principal and interest. They ignore the full PITI, principal, interest, taxes, insurance, plus all the other real costs. Add property taxes. National average effective rate is 0.9 to 1.1%, so $375 to $458 per month for a $500,000 home. But in high-tax states like New Jersey, 2.2%, Illinois, 2.1%, or Texas, 1.7%, it jumps to $917 to $1,042 per month. Homeowners insurance, $150 to $300 per month base, but rising fast. Many areas see 10 to 20% annual increases due to wildfires, hurricanes, or floods. Maintenance and repairs. The real rule isn't 1%, it's 1 to 2% of home value per year. $417 to $833 per month averaged over time for unexpected hits, like roof leaks or appliance failures, HOA fees. If applicable, $0 to $400 per month in many subdivisions. Total all-in monthly cost, realistically $3,400 to $4,800 for most $500,000 owners, often landing at $3,900 to $4,200. That's way higher than the just P&I estimate. Now the true income needed for comfort, not just bank approval. Conservative financial planners like those in the FIRE community say total housing less than or equal to 25% gross. You'd need $163,000 to $230,000 per year. A safer middle ground 30% gross, $136,000 to $192,000. The stretched but possible zone 35 to 40% gross, $102,000 to $164,000. But this is where house poor starts creeping in. These aren't arbitrary. They factor in maxing 401(k)s, building emergency funds, saving for kids, and living without constant worry. At $120,000 to $150,000 gross common for many middle-class families, you're often dedicating 35 to 45% plus to housing, leaving too little for everything else. The $500,000 trap isn't the price itself. It's how it quietly pushes even qualified buyers into financial vulnerability. Next, we'll look at who is actually buying these homes comfortably, the real profiles that make it work without the stress. Stay with me. The very first hidden cost, and often the most brutal one, is maintenance and repairs. Most people hear maintenance and think paint the walls every few years, fix a leaky faucet, maybe mow the lawn. They budget maybe $100 to $200 a month and call it good. But the real number that financial planners, homeownership veterans, and even Dave Ramsey and Financial Samurai quietly use is 1.2% to 2% of the home's value every single year, averaged over time. For a $500,000 home in 2026, that's $6,000 to $10,000 per year, or $500 to $833 per month, set aside just to stay ahead of wear and tear. And here's the killer part: most families don't set that aside. They think it won't happen to me this year until it does. In the first 5 to 10 years of owning, especially with newer or midlife homes, these are the big ticket hits that almost always show up: new roof, $15,000 to $35,000. Depending on size, material, location, asphalt shingles in most suburbs run $20,000 plus. Now full HVAC system, replacement central air plus furnace, $8,000 to $18,000. Major foundation repair or complete repipe of plumbing lines, $15,000 to $50,000. Replacing all windows in the house, $10,000 to $25,000. Basement waterproofing, sump pump failure, or main sewer line replacement, $10,000 to $30,000. These aren't rare disasters. They are normal life cycle events for a 10 to 40-year-old house, and almost nobody has a dedicated repair fund sitting there waiting for them. So what happens when the bill arrives? Most families don't have $15,000 to $30,000 cash ready. They do one of these: put it on a credit card, 18 to 25% interest. Pull from emergency savings, leaving them vulnerable. Take a home equity line or loan, adding more debt. Worst case, raid 401k or IRA, pay taxes plus 10% early withdrawal penalty plus lose future compounding. Every single one of those choices slows down wealth. Building increases interest costs and creates a snowball effect. One big repair turns into two, then credit card debt, then higher monthly payments. And suddenly the affordable $500,000 home feels like a second job you never signed up for. Compare that to renting the same house. The landlord handles the roof, the HVAC, the foundation, the plumbing. You pay rent and keep the rest for yourself. On average, renters avoid $5,000 to $15,000 per year in these surprise ownership hits in the early years. This isn't a maybe cost, it's a when cost, and it destroys budgets faster than most people realize, because it doesn't show up on the mortgage calculator or the Zillow estimate. It shows up in your actual bank account, usually at the worst possible time. We'll cover the next hidden cost next: property taxes that never stop climbing, and why they make the trap even tighter. Stay with me. The second major hidden cost that quietly erodes your budget is property taxes. And unlike your mortgage payment, they are not fixed. Property taxes are reassessed regularly, usually every 1 to 3 years depending on the county, and they rise with home values, local government needs, and inflation. Nationwide effective property tax rates average around 0.9 to 1.1% of assessed value per tax foundation and recent county data. But the real killer is the annual increases. Most areas see property taxes climb 3 to 7% per year on average, sometimes more during reassessment years or in fast-growing regions. Take a typical $500,000 home in 2026. Starting with the national average effective rate of 1.1%, your initial property tax bill is about $5,500 per year, or $458 per month. That sounds manageable. But over time, year 1 to 2 modest 3 to 4% increase to $470 to $480 per month. By year 5, cumulative 20 to 35% rise realistic in many markets, to $550 to $620 per month. By year 10, easily 40 to 70% higher, to $650 to $780 per month or more. In high growth or high tax states, it gets worse. Texas average rate 1.8%. Austin and Dallas suburbs often see 5 to 10% annual jumps due to rapid population growth and school funding needs. A $500,000 home can go from $750 per month to $1,000 plus per month in 5 years. Florida average 0.9%. Annual reassessments plus tourism-driven value increases push many homes up 6 to 12% yearly, especially coastal or Orlando areas. Arizona and North Carolina, fast-growing Phoenix and Raleigh-Durham markets see similar 4 to 8% annual climbs. The brutal part, property taxes don't decrease if home values dip. Assessments are sticky. Counties rarely lower them quickly even in downturns, so you pay more even if the market cools. Compared to renting, the landlord pays property taxes. You don't. Your rent might increase 3 to 5% per year, but you're not locked into a tax bill that rises forever regardless of market conditions. This is why property taxes feel vyotoihan for homeowners. They keep climbing year after year, often faster than wage growth for most middle-class families, which averages 2 to 4% after inflation. One reassessment year can add hundreds to your monthly payment overnight, and it never goes away. Taxes are already bad enough, but the next hidden cost makes them look tame. Homeowners insurance that has been exploding in many states. We'll cover that next. Stay with me, the trap gets tighter. The third hidden cost that is quietly turning ownership into a nightmare for many families in 2026 to 2027 is homeowners insurance. And unlike taxes, this one is rising at an alarming rate due to climate change, natural disasters, and reinsurance costs. Nationwide homeowners insurance premiums have been increasing 8 to 20% per year on average over the last few years, per NerdWallet Insurance Information Institute and recent 2026 forecasts from industry reports. In high-risk states, the jumps are even steeper, often 20 to 50% in a single year. For a typical $500,000 home in 2026, initial premium dwelling coverage around $400,000 to $500,000 plus liability and personal property, $180 to $350 per month in lower risk areas. But after just 3 years of average increases at 10 to 15% annual hikes, premiums can double to $400 to $700 per month. In extreme cases common in Florida or California, 100 to 200% total increase in 3 to 5 years, pushing monthly costs to $600 to $1,000 plus. Why is this happening so fast? Florida hurricanes and storm surge premiums up 30 to 50% annually in many counties. Some insurers are non-renewing policies entirely. California wildfires to rates surging 20 to 40% per year. Major carriers like State Farm and Allstate limiting new policies. Texas and Louisiana floods, hail, hurricanes to 15 to 30% annual increases common. Even moderate risk states like Arizona, Colorado, and North Carolina are seeing double-digit jumps due to reinsurance costs, insurers buying their own insurance skyrocketing after major disaster years. The biggest risk insurers are pulling out of high-risk areas. If your policy is non-renewed, you're forced into state fair plans, last resort coverage that costs 2 to 5 times more, or you go uninsured and bear all the risk yourself, a disaster waiting to happen. Compared to renting, renters only need renter's insurance, typically $15 to $30 per month for personal property and liability. The landlord covers the building insurance. You're not exposed to these massive premium spikes. Homeowners insurance is no longer a set-it-and-forget-it expense. It's a line item that can double or triple in a few years, and in some states it's becoming unaffordable or unavailable. When combined with rising taxes and maintenance, it turns a manageable $500,000 home into a cash flow killer faster than most people expect. Next up, the everyday operational costs that feel small but add up fast. Utilities and home upkeep that are always higher when you own. We're building the full picture. Stay with me. The fourth hidden cost is one you feel every single month. Higher utilities and operating expenses when you own a house compared to renting an apartment or smaller place. Owning a single-family home, especially a typical $500,000 one around 2,000 to 2,500 square feet with a yard, means bigger space, more appliances, and more systems to run. Utilities, electricity, water, gas, trash, internet, sewer are often 30 to 80% higher than renting a comparable apartment or townhome per U.S. Energy Information Administration (EIA) 2026 household energy data and average utility benchmarks. Real-world example for a $500,000 home: electricity plus gas larger, HVAC more square footage. Yard lighting $200 to $350 per month versus $120 to $200 in a 1,200 square foot apartment. Water plus sewer, lawn, irrigation, more bathrooms / showers, $80 to $150 per month versus $40 to $70. Trash / recycling plus internet / cable, $50 to $100 per month, often higher in suburbs. Total added monthly $150 to $400 compared to renting something similar in size / quality. And it gets worse with extras. Many $500,000 homes have in-ground sprinkler system or yard maintenance plus $50 to $100 per month in water / electricity. Pool common in warmer states plus $100 to $200 per month for chemicals, pump electricity and water. Larger HVAC running more often adds $50 to $150 per month in peak seasons. The risk here is compounding energy inflation runs 5 to 10% per year in many areas. EIA forecast 2026 to 2030, so these costs rise faster than rent in controlled leases. You can't just turn it off. The house needs heat, AC, water, lights. And unlike renting an apartment where utilities are often lower due to shared walls and smaller footprint as a homeowner, you bear 100% of it. Renters in a similar quality place pay far less in utilities, and the landlord covers major systems. You keep that $150 to $400 per month difference to invest, save, or enjoy. These aren't glamorous costs. They're the quiet daily drain that makes the $500,000 dream feel tighter every bill cycle. Next, the massive transaction costs you pay just to get in and get out of the house. Fees that can wipe out years of equity if you move too soon. The trap keeps closing. Stay with me. The fifth hidden cost is one most buyers only discover after it's too late: transaction costs. The fees you pay to buy the home and then to sell it later. These aren't small. They are 8 to 10% of the home's value that vanishes. Money that never builds equity, never appreciates, and never comes back. For a $500,000 home in 2026, when you buy, closing costs 2 to 3.5% of purchase price. Loan origination fees, appraisal, title, insurance, escrow, attorney fees in some states, prepaid taxes / insurance recording fees. Total $10,000 to $17,500, gone the day you close. Cash you'll never see again. When you sell, and most people do sell within 7 to 12 years, realtor commissions still typically 5 to 6% split between buyers and sellers' agents. For $500,000 sale, $25,000 to $30,000. Additional selling costs, staging minor repairs / updates to make it show well, transfer taxes, title insurance again, escrow fees, possible buyer concessions, easily $5,000 to $10,000 more. Total selling costs, $30,000 to $40,000 or higher. Grand total in and out, $40,000 to $50,000 plus. 8 to 10% of the home's value disappears into fees never to be recovered. If you sell after only 5 years and the home appreciates modestly, say 3% per year, your equity gain might be $80,000 to $100,000 before costs. But after transaction fees, you could break even or even lose money. The risk is huge for shorter ownership. Stay less than 7 years. You often lose money on the transaction alone, even if the home appreciates. Move for job, family, or life changes. You pay this penalty every time. Renters avoid this entirely. No closing costs, no realtor fees, no staging or concessions. Every dollar saved stays in your pocket. To invest, compound, or use for life. Transaction costs are the silent tax on home ownership that most calculators ignore, and they destroy returns if you don't stay put for a decade or more. We're almost through the list. Next, the biggest long-term hidden cost, opportunity cost, and the house poor lifestyle trap. The full trap is coming into view. Don't stop now. Now we come to the single most devastating hidden cost, one that doesn't hit your monthly statement right away but compounds over years and quietly robs you of real wealth, opportunity cost, combined with the house poor lifestyle trap. First, the opportunity cost part. This is the money you lock away that could have been working for you elsewhere. A typical $500,000 home down payment, $50,000 to $100,000, 10 to 20%. Plus the monthly difference versus renting, often $800 to $1,500 extra going to ownership costs. That money isn't building equity in the way people romanticize. It's dead capital sitting in drywall, shingles, and foundation. If instead you invested that same money, down payment, lump sum, plus monthly difference in a low-cost index fund, like the S&P 500, with a realistic long-term return of 7 to 9% per year after fees and taxes, $80,000 down payment alone grows to $160,000 to $200,000 in 10 years. $1,000 per month invested consistently adds another $170,000 to $220,000 compounded. Total opportunity lost $330,000 to $420,000 in 10 years. Liquid, accessible wealth you could use for anything. Meanwhile, the equity you build in the house after paying down principal minus transaction costs when you sell might be $200,000 to $300,000, but it's illiquid taxable if you sell early and exposed to market dips. You're trading liquid compounding money for paper equity that's hard to touch without more fees and risk. Then there's the house poor effect. When 40 to 55% of your take-home pay goes straight to housing, very common at $500,000 with average incomes. You become trapped. You don't dare quit a toxic job. One missed paycheck could start a spiral. You avoid career risks, no starting a business, no learning new skills that take time to pay off. Vacations become staycations. Eating out is rare. Kids' activities get cut. Having another child delayed or reconsidered because the budget is razor thin. Every decision filters through, can we afford this without jeopardizing the mortgage? You're asset rich on paper, you own a home, but cash flow poor and freedom poor in real life. Many people in this spot look back after 5 years and realize, I'm richer on the balance sheet, but I feel poorer than when I was renting. They're slow to build real wealth, slow to take risks, and slow to enjoy life, all because the house controls their monthly cash flow. Renters who invest the difference. They often end up with higher net worth liquid assets and more options. They can move for better jobs, pivot careers, or weather life changes without panic. This is the ultimate hidden cost, not just money lost, but time, freedom, and potential lost. We're at the end. Let's wrap it up with the full picture and what you can actually do about it. Stay with me for the conclusion. So here's the full unfiltered picture of owning a home in 2026 to 2027, especially at the $500,000 level that feels normal but often isn't. The 8 hidden costs we covered: maintenance and repairs, rising property taxes, exploding homeowners insurance, higher utilities, massive transaction fees, opportunity cost, house poor lifestyle, and the illiquidity trap. Don't hit one at a time. They stack. For a typical owner, they can easily add $20,000 to $50,000 plus per year in real out-of-pocket or lost opportunity expenses, money that quietly destroys budgets, savings rates, and long-term wealth if you're not prepared. The trap isn't that homeownership is always bad. It's that most people only calculate the visible part, mortgage payment, and ignore the invisible parts that compound over time. And in today's environment, High rates, high prices, rising insurance/taxes, stagnant wage growth for many. The hidden costs hit harder than ever. So what can you do right now? Calculate the full cost of ownership, never just P&I. Use PITI plus 1.5 to 2% of home value per year for realistic maintenance, plus higher utilities. Add projected tax/insurance increases 3 to 10% per year in many areas. Compare apples to apples. Find rent for a truly similar house, same size, bedrooms, location, schools. Take the monthly difference and assume you invested at 7 to 9% per year. Historical S&P 500 net return after fees/taxes. Run the 5-year and 10-year projections. Red flag rule: if the monthly gap is greater than $800 to $1,200 in favor of renting after full costs, pause hard. That gap compounds against you fast. Often $100,000 to $300,000 lost opportunity in a decade. If you still decide to buy, do it smart. House hack: aggressively rent rooms, build ADU, buy duplex/triplex. Put down 20% plus to avoid PMI and lower the loan. Choose a location with strong proven growth. Build a 12 to 18-month emergency fund before closing. Repairs and life happen. Lock in a long-term fixed rate. Don't gamble on ARMs unless rates drop significantly. Protect yourself from emotion. Ignore. I want my own house, I'll be priced out forever, or everyone is buying. Those feelings have already trapped a lot of people. Final thought: hidden costs aren't if, they're when. A house can be where you live, but it is rarely the fastest way to build wealth or freedom. The fastest way is usually controlling your cash flow, not letting a house control it. So where are you right now? Already in a $500,000 home and feeling the squeeze, still renting and investing the difference? Or staring at listings wondering if it's worth it? Drop a comment below with your rough numbers: household income, current rent/mortgage, down payment saved, city/metro target price. I'll give you straight feedback on whether it's realistic or if the trap is closing. Thanks for sticking through the full breakdown. This isn't easy to hear, but it's stuff you deserve to know before it costs you years of financial stress. See you in the next one. Choose the path that gives you more options, not fewer.